Property investment through a self-managed super fund has become one of the most talked about strategies among Australian business owners and investors, and for very good reason. Done well, it lets you build wealth inside one of the most tax-advantaged environments the system offers. Done carelessly, it can trigger breaches so serious that the fund loses every concession it has. This is what we'll cover in this video. We'll walk through what an SMSF can actually buy, the powerful business premises strategy, how borrowing works, the real tax numbers, what's changing from the 1st of July 2026, and the compliance traps to avoid. I'm from Quantum House Australia, accountants and tax advisors, and this is property inside your super fund, explained properly. Here's the path we'll take. First, why SMSF property is so appealing in the first place, then the tax environment that makes it work, and exactly what kinds of property a fund is allowed to buy. We'll spend real time on the standout strategy, holding your business premises inside the fund and leasing them back. We'll cover borrowing through a limited recourse borrowing arrangement, look at the tax advantage in hard numbers, and flag an important change arriving on the 1st of July 2026. We'll bring it to life with a worked example, run through the compliance risks, and finish with the key takeaways and how we can help. It's a lot of ground, but each piece matters. So let's begin. So why all the interest? Because the tax environment inside super is quite simply extremely favourable, and we'll put numbers to that shortly. When you hold an investment property inside your fund rather than in your own name, the income and the eventual capital gain can be taxed at a fraction of your personal rate, and in retirement potentially not taxed at all. That's the upside, but, and it's an important but, SMSF property is governed by strict rules. Breaches can be catastrophic, up to the fund being made non-complying and losing all of its tax concessions in a single year. This is a strategy that rewards getting the detail right and punishes getting it wrong. That's the balance we want you to hold in mind throughout. Let's put those numbers on the table, because they're the whole foundation. Concessional contributions going into the fund are taxed at just 15% on entry. Investment income earned inside the fund during the accumulation phase, including rent, is taxed at 15%. Capital gains on an asset the fund has held for more than 12 months are effectively taxed at just 10%, thanks to the 1/3 CGT discount that complying funds receive. And once the fund moves into pension phase, income and capital gains on assets supporting that pension are taxed at 0. Compare those rates to a personal marginal rate of up to 47%, and you can see immediately where the appeal comes from. That gap, compounded over many years, is the entire reason this strategy exists. Now, what can a fund actually buy? An SMSF can purchase both residential and commercial property, provided the purchase fits the fund's documented investment strategy and passes what's called the sole purpose test. That test means the property must be acquired purely to provide retirement benefits to members, not to give anyone a present-day perk. And here's the line you must never cross. Residential property acquired by an SMSF cannot be rented to or used by a member or any related party of the fund. Not for a weekend, not at market rent, not at all. It's an absolute prohibition. Commercial property is different, and that difference is where the real strategy lives, which is exactly where we're going next. This is the strategy that makes business owners sit up. The rules allow a special exception for commercial premises. Your SMSF can own your business premises and lease them back to your own operating business. Think about what that achieves. Your business pays rent, just as it would to any landlord, and that rent is fully deductible to the business. But instead of disappearing to a third party, it flows into your super fund, where it's taxed at only 15% or nothing at all in pension phase. Over time, you're effectively buying your own premises inside a tax-advantaged environment, building an asset for your retirement with money that used to be someone else's rent check. To qualify, the property must be what's called business real property, used wholly and exclusively in a business, and the lease must be on strictly commercial terms, documented properly, at genuine market rent. Of course, many funds don't have the full purchase price sitting in cash, and that's where borrowing comes in. An SMSF can borrow to buy property through what's called a limited recourse borrowing arrangement, or LRBA. Here's how it works. The property is held in a separate holding trust, a bare trust, until the loan is fully repaid, at which point the fund takes legal title. The limited recourse part is the key protection. If the fund ever defaults, the lender can only come after the single asset bought with that borrowing. They cannot touch the fund's other assets. One important warning though, if the lender is a related party, say a member or their family, the loan must be on terms that meet the tax office's strict requirements. Non-compliant related party loans are among the most common SMSF breaches we see, so this is not a corner to cut. Let's make the advantage concrete by putting the two worlds side by side. Take rental income held inside your SMSF. It's taxed at 15% and 0 in pension phase. Held in your own name, that same rent could be taxed at your marginal rate up to 47%. Now take a capital gain on a property held longer than 12 months. Inside the fund, the effective rate is 10% and again 0 in pension phase. Held personally, even after the 50% general discount, you could be paying an effective rate of up to 23.5%. On a single year, that's meaningful. Over a 10 to 20 year investment horizon, the compounding effect of paying a fraction of the tax and reinvesting the difference year after year becomes very significant indeed. This is the maths that drives the decision. Now, an important update, because the rules are changing and it's directly relevant to property held in super. From the 1st of July 2026, a new measure called Division 296 applies an additional tax to members with very large superannuation balances. For the portion of a member's total super balance between $3 and $10 million, an extra 15% applies to the realised earnings attributable to that slice, bringing the total tax on that portion to around 30% for any portion above $10 million. The additional rate is 25%, taking the total to around 40%. Both thresholds are indexed over time, and crucially, after revisions, the tax applies to realised earnings only, not to gains. You haven't actually crystallised. Why does this matter here? Because SMSF property is a big ticket asset, and it can push a member's balance over that $3 million line. For most members, the SMSF environment remains highly tax advantaged, but higher balance funds need to plan for this deliberately. Let me bring all of this together with a hypothetical example. Meet Sophia and Marco, fictional owners of a growing manufacturing business who'd been renting their factory for years, writing a rent check to a landlord every month with nothing to show for it at the end. With a combined SMSF balance built up over time, they bought that very factory as business real property inside their fund, using a limited recourse borrowing arrangement to fund part of the purchase. Now their operating company leases the premises back from the fund under a formal lease at genuine market rent. The effect is striking. The rent the business pays is still deductible, but now it flows into their own super fund, taxed at just 15%. And when they eventually retire and move the fund into pension phase, that rental income and any capital gain on the factory can be entirely tax-free. Over a 15-year horizon, the difference runs well into the hundreds of thousands. Crucially, they got the structure right. A compliant borrowing arrangement, a genuine arm's-length lease, and an annual valuation. Done carelessly, the very same arrangement could have made the fund non-complying. The strategy is powerful, but only when the rules are followed to the letter. This scenario is illustrative only. Every fund's circumstances differ. That last point deserves its own moment because it's the heart of the matter. The same strategy can produce two completely different outcomes, and the only variable is the execution. Done carelessly, an off-market lease, sloppy borrowing paperwork, a missed annual valuation, a related party slip, and the tax office can make the fund non-complying. When that happens, the fund doesn't just pay a penalty, it can lose every tax concession it has, with consequences that dwarf any saving the strategy was meant to deliver. Done right, sole purpose respected, leases genuinely at arm's length, borrowing documentation that meets the rules, valuations done every year. And the strategy delivers exactly the advantages we've described. Same structure, same property, wildly different results. The difference between a powerful outcome and a costly one sits entirely in the detail and the discipline. So let's name the traps directly. First, the big one. Acquiring residential property from or leasing it to a related party, strictly prohibited, no exceptions. Second, related party leases that aren't on genuine arm's length terms. If the rent isn't at market or there's no formal lease, you're exposed, including to non-arm's length income rules that can tax that income at the very top rate. Third, borrowing documentation that doesn't meet the tax office's terms, especially on related party loans. And fourth, the quieter ones that catch people out, failing to value the property at market value every year and allowing the property to be used for any personal purpose. The tax office takes a near zero tolerance approach to most of these. The consequences can include the fund being made non-complying and significant civil penalties. None of these traps is hard to avoid, but every one of them needs someone paying attention. Let's pull the threads together. 1. The SMSF tax environment is genuinely favourable, 15%, 10% and 0 in pension phase. 2. Residential property can never be rented to a member or a related party. 3. Business premises are the exception. They can be leased back to your own business at arm's length rent, and that's the standout strategy. 4. A fund can borrow to buy property through a limited recourse borrowing arrangement, but related party loans must meet the tax office's terms. 5. From the 1st of July 2026, Division 296 adds tax for balances over $3 million, so larger funds should plan ahead. And 6. The thread running through all of it. Breaches can make the fund non-complying, so get proper advice and get the structure right from the start. Do that, and SMSF property can be one of the most effective wealth-building tools available to you. This is exactly the kind of work we do every day. At Quantum House Australia, accountants and tax advisors, we work in close partnership with licensed financial advisors and legal practitioners to give you holistic SMSF property advice. We review your compliance arrangements against the rules, sole purpose, arm's length leasing, borrowing terms. We help prepare your borrowing documentation, manage your annual market valuations, and make sure your fund's records correctly reflect every property transaction. And whether work is genuinely legal, the bare trust deeds, the borrowing and lease documents, or defending an ATO compliance dispute, our colleagues at Australian Tax Experts, who are tax advisors and lawyers, handle that side alongside our accounting. One team, both the numbers and the law, so nothing falls through the gap between them. So, if you're considering property in your self-managed super fund, or you already hold it and want the comfort of knowing it's compliant, let's talk before you commit. It's a powerful strategy, but it's unforgiving of mistakes. And the best time to get the structure right is at the very beginning. Quantum House Australia reviews arrangements, prepares borrowing documentation, manages valuations, and keeps your fund's property on the right side of the rules. Visit quantumhouse.com.au or call our Sydney office on 1300 809 697 and speak with a senior advisor. Quantum House Australia, accountants and tax advisors, setting a new standard. Thank you for watching.